welcome to today's episode of the Simply Financial Podcast. I'm your host, Christopher Calandra, and I want to increase your financial IQ with today's episode. I want to talk to you about stock splits. A stock split occurs when a publicly traded company divides its shares to increase the number of shares. So a real life example is in the summer of 2026, CrowdStrike, a large cybersecurity company, is doing a 4-for-1 stock split. When the company announced it, the stock was at around $800 a share. And if that holds, when they finalize the split, every shareholder that had one share will end up with 4 shares, and the price will go from $800 to $200. So that's kind of a real life example. The split increases a company's share count. So you think about it, the person had one share in my CrowdStrike example, now they have 4. So the company increases the share count and it reduces the share price. It went from 800 to 200. What doesn't change is the company's total market value. That stays the same. The company's underlying fundamentals, how much they earn, their dividend yield, all those other investment metrics, they remain the same also. I'd have you think about a pizza. You could have a pizza that is cut into 6 slices, or they could take the same size pizza and cut it into 12 slices. It's still the same size pizza. Hopefully that silly little pizza example works. Actually, I would love to have some pizza right now. Why would a company do this? Well, in many instances, they make a stock price more accessible. Going back to my CrowdStrike example, for some people, $800 is psychologically expensive. It's not really, but it is, and you can't buy that many shares compared to $200. So oftentimes, to make it more accessible, the stock more accessible, especially to retail investors, the stock split will make sense. It also has a tendency to boost liquidity. More shares will trade hands, and you'll get an increase in trading volume, which may be desirable. Now, some stock splits can follow rallies where a company does very, very well in a short period of time, and then they want to do the stock split. And because of this, a lot of investors view a stock split as a sign of management's confidence in the company's fortunes. Now, I want to be clear about this. That could very well be true. It's not necessarily true, though. It really depends on the company and the situation. You can't draw an automatic conclusion, but it is something to consider. I think the best approach is that this stock split mechanism is mostly a cosmetic action. After a split, investors' total position does not change. If you own $5,000 of a company, or $50,000, or $500,000, once the stock split takes place, you still have $5,000, $50,000, or $500,000 in the stock. Your shares will have adjusted based on the stock split formula, but you still have the same amount of money in the position. If you're thinking about taxability, it doesn't affect taxability. Your overall cost basis stays the same. It's adjusted for tax reporting purposes. My opinion is to view a stock split as one data point. It's not an automatic reason to buy a company or to hold a company or to sell a company. It's simply one data point. Before we finish up, I want to talk about something that's less frequent in the marketplace, but some companies can do a reverse stock split. That is when the price gets low and they want to offer investors a higher price because it, again, psychologically might be more appealing. I'll also explain why, for institutions, this might be worthwhile if you're trying to attract institutions to buy your stock. Like the CrowdStrike example, I'll give you one on a reverse stock split. Back in 2024, Sirius XM, the satellite radio company, they did a 10-to-1 reverse split. So the stock was around $3 or $4 when it was announced, and then the stock went up to $30 or $40 after the reverse split took place. And so when a company has a very low stock price, it can have a stigma associated to it for retail investors. Like, why is it so low? Now, again, that's one data point. Just because the price is low doesn't mean it's a bad stock. It doesn't mean you should automatically buy, hold, or sell it. But it does oftentimes have a negative connotation for retail investors, especially. When you look at institutional investors, pension plans, endowments, large trusts, oftentimes they have rules about not investing in companies below a certain price. Could be $10 or below. Oftentimes it's $5 or below. It's almost always $1 or below. So when a company does a stock split, they might be taking advantage of getting on the radar of institutional investors because they now have a price that can be acceptable to institutional investors. As I said, you don't see a lot of reverse splits, but I did want to throw that out in an effort to give you a full picture of stock splits. So that's today's episode. I hope you found the information to be worthwhile, stock splits. And I will be back with you on the next episode of the Simply Financial podcast very soon. In the meanwhile, subscribe to the Simply Financial podcast if you haven't done so already. Have a great day. I'll be back with you very soon.
The views expressed are not necessarily the opinion of Osaic Wealth, Inc., and should not be construed directly or indirectly as an offer to buy or sell any securities mentioned herein. Investing is subject to risks, including loss of principal invested. Past performance is not a guarantee of future results. No strategy can assure a profit nor protect against loss. Please note that individual situations can vary. Therefore, the information should be relied upon when coordinated with individual professional advice. Please note, the information being provided is strictly as a courtesy. When you link to any of the websites provided here, you are leaving this website. We make no representation as to the completeness or accuracy of information provided at these websites. Nor is the company liable for any direct or indirect technical or system issues or any consequences arising out of your access to or your use of third-party technologies, websites, information, and programs made available through this website. When you access one of these websites, you are leaving our website and assume total responsibility and risk for your use of the websites you are linking to. Securities and advisory services are offered through Osaic Wealth, Inc., member FINRA, SIPC. Insurance services offered through Elliott Wealth Management Services, LLC, not affiliated with Osaic Wealth, Inc.